Jupiter Fund Management. Ticker symbol is JUP. It's based in the UK. It's currently trading for 94 pence per share and it pays a dividend twice a year. The last one I received was for 9.2 pence per share. And usually with companies that pay twice a year, they'll have what's called an interim payment and then a final payment. And the interim payment is generally considerably smaller than the final payment. So if there is a big variation in what you receive, that's pretty normal. So on their website, even when I tried to look into their products, it said that if I'm not a resident of the UK, that I can't proceed any further. And it seems to be quite exclusive. When I was researching them a little bit, they seem to deal with like institutions and exclusive funds. But they seem to have a lot of interest in a lot of different financial instruments. There's quite a bit of financial lingo and abbreviations that I didn't understand myself, so I'll try and explain them as basically as I can. So at the moment, not having a good time at all. And it doesn't look like things are going to be getting much better for a lot of countries, but the UK, I'm hearing a lot of bad news and a lot of very pessimistic looks for the future, which is never nice to see. So be wary where you're investing any of your money, because the chances are it will go down in the near future and it will continue to do so for quite a while. I have a feeling something very big is finally coming to a head. The British pound actually became on par with the dollar, and the euro also is as well, which is pretty staggering, to be honest. It's quite scary. But anyway, Jupiter Fund Management, it's based in London in the UK, and it's an asset management company, and through its subsidiaries it acts as an investment manager to authorised unit trusts, to SICAVs, and this is an abbreviation. It basically means that a company whose capital and shares are not specified in advance, and the capital is divided into company shares and investor shares. These are pretty common in Europe. It also has ICAVs, which are Irish Collective Asset Management Vehicles, which are similar, but they're regulated and they're attractive because of their kind of legal structure. There's also ICVCs, which are investment companies of variable capital, and there's OEICs, which are open-ended investment companies. And they're also involved in investment trust companies, pension funds, and other specialist funds. So it's fancy stuff. The company offers a number of investment strategies within 4 core asset classes, which are equities, fixed income, multi-asset, and alternatives. So they essentially, to kind of sum everything up as simply as I can, they seem to deal with exclusive funds and exclusive clients, such as institutions. But they seem to have an interest in a lot of different financial instruments. And they operate in offices in the UK, in Ireland, Austria, Germany, Hong Kong, and Italy, among others. And the product type is categorized into pooled funds and segregated mandates. And this segregated mandates, it just means exclusive funds, like institutions. So they're in the financial sector and in the investment services industry. They currently have a market cap of £554.59 million. Current PE ratio is 3.4. They have a revenue of £617.8 million, positive earnings per share of 29 pence, and a very high dividend yield of 17.33%. And this is not sustainable. I can't see any company paying a 20% dividend yield consistently. So they'll either drop it down or they just won't pay it. It's quite common. As of this moment, over the last year, their profit margin is 24%, which is good. And over the last quarter is 6%, which is not great, but still in the green. They have an annual debt to assets ratio of 32.8%, which is good. I've showed it in a previous video, but McDonald's actually has an annual debt to assets ratio of 108%. So it's quite common for very big companies and franchises to have massive debt. But over the last quarter, their debt to assets ratio is 40%. So it's gone up a little bit. And their annual cash flow from operating is £188.9 million. From investing is negative £12 million. And from financing is negative £167.7 million. Over the long run, it's not looking very good. So the company was founded in 1985, and this graph goes back to 2010. And when it opened, it was £1.90 per share, and it's now 94 pence per share. Very scary. Here on the peak, we can see the 22nd of December of 2017, it was £6.21 per share. That seems to be the best they've ever really done historically. It's very scary times for a lot of investors. But when you're in dividend investing for the long run, these can be considered fantastic times because anything that you may want to buy is at a discount. But it's very important that you do not chase companies for massive dividend yields because they'll just not pay them or they'll drop them. So there's a 52-week low of 90 pence per share, and we're quite close to that at the moment, and a 52-week high of 270 pence, so £2.70 per share. So looking at their dividend history, it seems to be, well, I wouldn't call it very consistent. And as we saw from the graph, 2017 was when their share price was at its highest point. So they have over here in this category, on the right is the declared amount. This forecast amount, to be honest, I don't really see how it's very useful to anyone because it could change in any moment. It's entirely up to the company, how much they pay and when they pay it. But they seem to be decent at paying dividends. And you can also see here that the difference between an interim and a final, there's a bit of variation. So it is quite normal. I always like to see special dividends as well. Special is just like a bonus dividend. It's just one that you weren't expecting. But yeah, I wouldn't call it hugely consistent, but generally companies that pay once, a lot of European companies will pay once a year, and other companies that pay twice a year, they're not really the go-to for dividends. So as far as they go, this is actually quite good. The only thing is I can't see massive growth in it. So that's just something to keep in mind if you're deciding to invest into them. So overall, their profit over the last year is good. Their debt over the last year is good. But I think this is just a recession. That's the simplest way I can put it up. A lot of the profits that we'll see in companies are going to start falling. A lot of them will have to take on debt. So debt to assets ratio is going to go up. And to be honest, I think it's unavoidable at this point. There was a lot of money distributed to a lot of people when everything was locked down, and now we're paying the price. So I do think that it would be a good investment, but it's by no means a get rich quick one, and it will, I can't say for certain, but I am fairly sure that it is going to decline pretty consistently for the next while. And recessions tend to last, the average one tends to last, I think it's 2 years, but there is simply no way of knowing. Anybody who tells you they know for sure is either a dangerous idiot or a liar. So invest as carefully as possible, do as much research as you can, and as always, don't invest what you cannot afford to lose.